Hi, welcome to this accounting tutorial. My name's Philip. For those of you who don't know, I do work as an accountant in a private practice. I deal with clients with a wide range of businesses. I deal in accounting and taxation and superannuation, self-managed super funds. Now, in this tutorial, I'll go through with you in how to analyze a set of financial statements. Now, in accounting, what generally is done is it's a process of gathering and reconciling and preparing from your source documents, from tax invoices and bank statements and bookkeeping to presenting a set of financial statements for a particular financial year or a financial period. Now, what happens after we have prepared a set of financial statements? Because that's not the end of the line. So what happens after that? Well, we conduct an analysis of the financial statements. So we look at the numbers in the income statement, balance sheet, statement of cash flows, and we get a picture of the business. Now, these financial statements tell a story. They basically tell a story of how the particular business has performed over a number of years. And that's why you need a set of financial statements to compare at least 2 years. And in most of the financial statement presentations that you see, there is a 2-year comparative at least. Now, in order to prepare a full set of analysis with ratios and to get a picture of how the business has performed over a number of years, you may need at least 3 years worth of financial data. However, if your business has only been in operation for 2 years or less, then a 3-year set of financial data is not practical, and therefore you will need to work with 2 years worth of financial statements data. Now, I'm going to share my screen and show you this Excel sheet. Now, I trust you can all see this screen. What we're looking at here is a company, XYZ Pty Ltd. We've got financial statements for the year ended 30th of June 2020, and we have some comparative figures for 2019. Now, there are a number of ways to analyze a set of financial statements. One way is to have a look at just at the income statement, balance sheet, and across to the right statement of cash flows, and do a very simple analysis to state whether the business is, in a good financial position and whether the business has performed, financially well. Another way in analyzing these financial statements, which I'll show in another video, is called a ratio analysis. Now, a ratio analysis is widely used by analysts and also accountants in analyzing the business performance and position by using a wide range of measures. For example, gross operating margin, net operating margin, or gross profit margin and net profit margin, current ratios, debt to equity ratios, liquidity ratios, operating cash flow ratios. All these ratios can be used in order to determine the business's financial viability and financial sustainability. Now, in order to use this ratio analysis, at least 2 years will need to be used. If even better, 3 years will need to be used in order to assess the performance of the business over the 3-year period. However, in today's video, we're going to just look at this set of data, income statement, balance sheet, statement of cash flows, and analyze it by just using the figures that's presented there. In the next video, I'll show you how to conduct a ratio analysis. And then in another video, after all the financial statement analysis and after we get all these figures, I'll show you how we can value a particular business. That'll be pretty much the end of the line, business valuation. Now, it's very simple to value a public company. You know, we have records of the shares and the value of these shares, and there's many different ways on how to value the company. But how do we value a private company? And that's a little bit tricky. And so I'll show you some ways in how to value this company, XYZ Pty Ltd. So we're using XYZ Pty Ltd for demonstration purposes. So for today, I'll show you very quickly how to interpret the data on the basis of income statements and balance sheet. Okay, so we've got a income statement for the year ended 30th June 2020. We have trading income in 2020, $600,000. In 2019, $500,000. What does that mean? Well, one way of analyzing it and interpreting it, we say it means that in 2020, the business has increased its income, its sales income by $100,000 or by 20% as compared to last year. Now, whether that's a good thing or a bad thing, it's up to each and every one of you to interpret that. Maybe the director may be looking at a 40% increase in income. And if the income increased only by 20%, it has not met the director's expectation, and therefore it has not performed in accordance to the director's expectation. Now, your cost of sales, on the other hand, in 2020, $285,000. 2019, $240,000. Now, at this stage, a income statement for a trading business with inventory and stock will have revenue, cost of sales, a gross profit, and then the expenses in its main categories, and then a net profit. So cost of sales in 2020 for this business is $285,000. In 2019, it's $240,000. So we have, on one hand, the cost of sales has increased in 2020 by $45,000 or by 19% in comparison to 2019. And then the gross profit, $315,000, and in 2019, $260,000. So gross profit. So you can see here, while the cost of sales have increased, this is because the income has increased. But therefore, as a result, the gross profit has also increased by $55,000 or by 21% in comparison to 2019. Now, let's have a look at some of the expenses. We have employee benefits. So that's basically wages, super, annual leave, long service leave payouts, staff amenities, staff training, all these sort of things are classified as employee benefits. In 2019, it was $95,000, but in 2020, somehow it reduced to $90,000. So it reduced by $5,000 or by 5%. Rent and outgoings. In 2019, it was $70,000, but in 2020, it's $80,000. So this particular expense, rent and outgoings, includes obviously rent on the premises and council rates, water rates, land tax, electricity, insurance. All these are part of the outgoings. So these increased by $10,000 or by 14% in comparison to 2019. Depreciation. That's a non-cash item. It's basically a decline in value of the non-current assets of the company. So in 2019, it was $35,000. In 2020, it's $30,000. Again, it decreased by $5,000 or by 14%. Now, the way we do the percentage changes is we take the difference between 2 years. So in this case, the difference between 2020 and 2019, and we divide that by the 2019 figure, which is a base amount. And then we multiply it by 100 in order to get the percentage reduction. Other expenses, other expenses, obviously those that don't fall into those three categories. In 2019, it was $75,000. In 2020, it was $65,000. So the company did okay in reducing its other expenses by $10,000 or by 13% in comparison to 2019. Interest, $12,000 in 2019 and $10,000 in 2020, a marginal decrease by $2,000, but a 17% decrease as compared to 2019. So we see here the total expenses across the 2 years, and it decreased by $12,000 or by 4%. Now, in 2019, according to these mathematics, the company made a loss of $27,000. Now, in 2020, the company made a profit of $40,000. Now, the turnaround is $67,000 as compared to these 2 years. Because 2019 was a loss, which is in a minus figure, and 2020 was a profit. Now, that in turn led to a very substantial increase in the net profit of 248% between 2020 and 2019. So in the income statement, again, you have a director's expectation. And if there's shareholders in the company, they may also have an expectation that for example, if these percentage change figures are higher in their expectations, then according to the financial statements presented, the company has not met the expectations of the change in percentage. Although it's dropped its expenses, it's increased its net profit, but it may not be enough in the viewpoint of a director or a shareholder or a majority shareholder of the company. Let's now look at the balance sheet. Now, the balance sheet is as at a particular date. So here the balance sheet is as at 30th of June 2020. So we have assets, current assets, we have cash, prepayments, receivables, inventory. So you can see from these figures, there's an increase in the cash of $10,000. Prepayments have decreased by $5,000. Now, these prepayments could be prepaid expenses that the company apportions over a number of months or a number of years, and then slowly takes out away from prepayments and puts it into the income statement. Receivables are your trade debtors. So in 2019, they were $50,000. In 2020, it's $30,000. That could be a good thing because we see debtors reducing, which means one of two things. The first thing, the company has collected more money from its customers, or two, bad debts have been recorded, which is not a very good thing. Inventory. Again, in 2019, it was $65,000. In 2020, it's $25,000. Again, it's a good thing that the inventory has reduced because it could mean one of two things as well. One is the company has sold more stock and has sold more stock than what it had in the previous year. Or two, which is not a very good thing, the company has had to write off stock because it's been old or obsolete, or the stock is not functioning any longer. So there's reasons for all of these increases and decreases. I'm just giving you some examples, and they could be real life examples of real businesses who are experiencing these things. Now, at this stage, we see the current assets. These are assets that can be easily converted into cash as and when the business requires. So the current assets, the total has reduced, obviously because of the reduction in inventory and a reduction in receivables as the main types of reduction, which may be a good thing, may not necessarily be a good thing. So total current assets reduced by $55,000, or reduced by 41% in comparison to 2019. Now we have non-current assets, or long-term assets. So these are assets that the business holds for more than 12 months in order to provide future economic benefits for the business. And in turn, the business uses these plant and equipment and machines in order to generate income for the business. So in 2000, we have plant and equipment at written down value and motor vehicles at written down value. Now, when you see a proper balance sheet, it will have plant and equipment at cost, and then another line, less accumulated depreciation. Likewise, with motor vehicles and other non-current assets, it will have motor vehicles at cost, less, and then another line, less accumulated depreciation. But for the purpose of this exercise, we just do these at written down value. So notice how these have reduced in 2020 from 2019 because of the depreciation amount that's been included in the income statement. And again, plant and equipment reduced by 17% and motor vehicles reduced by 17%. Intangibles, goodwill, that doesn't change. That's how much perhaps how much you paid for the business. So that's an intangible. So that comes back to you when you sell the business. So we see the total assets at the end at 30th of June 2020, $430,000 compared to 2019, $515,000. So that's a reduction of $85,000, or a reduction of 17%. Now let's go to the current liabilities. So current liabilities includes any trade creditors, any other creditors, credit card liabilities, tax office liabilities, superannuation liabilities, income tax payable, and so on. And employee benefits provisions. So payables. In 2019, it was $15,000. In 2020, $5,000. So it's reduced by $10,000, or by 67% compared to 2019. Now that could be a good thing because the company has been able to pay its creditors. ATO payables, likewise. In 2019, it was $8,000. In 2020, $2,500. Again, it's reduced by $5,500, or by 69%. Again, it's a good thing. The business is paying off its ATO obligations as and when required. Income tax payable, there was none in 2019 due to the loss. In 2020, it's just made up a random figure, $3,600. So obviously it has increased by 100%. Employee benefits in 2019, it was $18,000. Now it's $12,000, so it's reduced by $6,000. Now that basically may mean that employee benefits have been used throughout the particular period by way of paying out employees' annual leave, or long service leave, or superannuation payments. So employee benefits payable has reduced by 33% as compared to 2019, and their total current liabilities overall reduced by $17,900. It means that the company has been able to pay its current obligations, and it's reduced by 44% as compared to 2019. Now let's have a look at the non-current liabilities. That's the long-term debts or commitments of the business. So we have a bank loan, 2019 was $210,000. In 2020, it's $200,000. So it reduced by $10,000 as a result of principal and interest repayments, or reduced by 5%. Director's loan is basically what the director contributes to the business and what the director takes out of the business. So in 2019, it was $291,000. Now, at this stage, we can see that there's been a lot of assets in the company, and there was a loss. So we need to ask the question then, how are these assets funded and how was the loss funded? So see this director's loan figure, that was quite high. It may be that much of these assets and the loss was funded by the director. Now, how is the loss funded by a director? Well, obviously, if a director pays expenses of the company out of their own accounts, that's how the company creates an expense, and in turn, the company has a loss. So we can say that this money, the director's loan, is what the company needs to pay to the director at 2019, but at 30 June 2020, it was $197,500. So the company has made repayments of $93,500 to the director. And in this instance, the director is entitled to take of that money, and they don't need to declare it in their tax returns because it's a loan. It's basically a loan from the director to the company. So the director's loan reduced by 32%, and the total non-current liabilities reduced by 21%. So overall, the total liabilities reduced by $121,400, or reduced by 22% in comparison to last year. Now, total equity, I just need to fix up this formula. So the equity was a minus in 2019 because of the net loss, but now the net assets is $9,400. Now, net assets do need to equal the total equity. So in this instance, we have a turnaround of $36,400 in the net assets and in the equity, which means it has improved or increased by 135% as compared to last year, mainly because of the turnaround of the loss into a net profit and because of repayments of non-current liabilities. Now we go into the statement of cash flows. Now, today I'm just going to provide an introduction, and next time we'll have a look at more detail in this cash flows. But a cash flow statement is composed of the following. Now there's two ways of doing a cash flow method. One is called the indirect method and the other one's called the direct method. The method that we're doing is the net profit method. So we take the net profit of the company and then we add back the depreciation. And then we start using the cash flows from operating activities. So we have receipts from customers, payments to suppliers. So any cash payments need to be a negative amount. A net profit or a loss can be a negative amount as well. Increase in receivables. Now the increase or decrease in receivables, an increase in receivables is a negative amount because it means that you're providing for more debtors. However, a decrease in receivables is a good thing, and that's a positive amount because that provides more cash inflow for your business. Increase or decrease in payables. So an increase in payables is a positive figure because again, it provides more cash flow for your business, whereas a decrease in payables is a negative figure because it means that you have paid cash to your suppliers or to your creditors. Increase or decrease in stock. An increase in stock is a negative figure because it means that you've paid money to purchase stock. However, a decrease in stock is a positive figure because it means you have sold stock and therefore you have increased your cash inflow. So when you add your net profit, add back all of your depreciation, you come up with a net cash flow from operating activities, $143,500. Now, the next component is a net cash flows from investing activities. So that includes any property, plant, and equipment, including motor vehicles that you have purchased or sold, which go into the statement of cash flows from investing activities. And then the last component is cash flows from financing activities, which includes your non-current liabilities. So any proceeds from borrowings or any loan repayments get allocated to cash flows from financing activities. Then when you add the cash flow from operating activities, add your net cash from investing activities, which could be a minus, add net cash flow from financing activities, which also could be a plus or a minus amount, gives you your net cash inflow or outflow for the year of $10,000. Now, once you've determined your net cash inflow or outflow, you then come to the cash at the beginning of the year, $5,000, which is there in 2019. You add that, which gives you your cash at the end of the year, $15,000. So the cash position, it tells you, the statement of cash flows tells you how you arrived from $5,000 in 2019 to $15,000 in 2020. And the movements in the balance sheet helps in calculating how you arrive at the cash balance at the end of the year. But the statement of cash flows is a further analysis which helps you in how to work out the movement of the cash from one year to another year. So I trust that this introduction of analysing financial statements is helpful. Next time we're going to have a look at more detail in the cash flow statement, and we are going to do a ratio analysis of the business. Now at this stage, what we've done is a very simple analysis of the income statement and balance sheet of the business. Now on its own, the figures may look okay. However, if we get 2, 3, or even up to 5 competitors of the business in the same industry, and we see that their figures are higher than this particular business, so what we're doing now is we're going to compare to the industry figures. If their figures are higher, that means it's not okay for the business. There's something in the business that needs to be fixed. And we need to show that to the director and put that to his attention, bring that to his attention, his or her attention, and that way the director will then do things within the business to improve the financial figures. It may mean that the business is selling their stock at a lot less prices than its competitors, and buying their stock at a lot more cost than its competitors. And so the director will need to find ways in how to reconcile that together and bring it all together in order to tie in these financial statements and the ratios in terms of performance and position, to tie it in with the industry and with what it should be as compared to a benchmark of the industry. Now, at this stage also, the tax office has benchmarks of each industry. So they have a cost of sales benchmark, they have a sales benchmark, they also have a net profit benchmark, They also have rent benchmarks and so on and so forth, tailored for each industry. Now, if your business falls below those benchmarks, there's something wrong, and that needs to be brought to the attention of the director, and the director will need to do something about that to bring its performance up to the benchmark that's required. So I'll show you all of these things in the next coming videos, but I trust that today's video has been enlightening in just analyzing briefly and simply a set of financial statements, which includes the income statement and the balance sheet.